Hello, everyone, and welcome back to the Saigal Sea Trade podcast. I'm research analyst Trisha Mohite, and I'll be the host for today's episode. Today, we're going to talk about a really interesting topic revolving around Venezuela, and for that, we have Mr. Sandesh Ghandat, who is an expert in shipping and commodity markets, and he'll be joining us in this episode. So, welcome to the podcast, Sandesh.
Thanks, Trisha. Thanks for inviting me once again. It's a pleasure to be here.
All right, so let's start with some context for our listeners. Now, we know that Venezuela holds the world's largest proven crude oil reserves. It's almost about 303 billion barrels as of 2023, and that's a staggering 17% of the global reserves. Yet, despite this wealth underground, the country produced only about 875,000 barrels per day in 2024, and that's accounting for less than 1% of global oil production. So, Sandesh, why is Venezuela struggling despite its immense resources?
Well, Trisha, first of all, great question. So, Venezuela's challenges are deeply rooted in years of mismanagement, then corruption, and kind of a crippling international sanctions. They have a state-owned oil company, PDVSA. It's once a powerhouse in the global oil industry and has suffered from a chronic underinvestment, widespread graft, and an exodus of skilled labor. Decades of resource misallocation and politically motivated decisions have left the country's refining capacity in shambles. And it leads to inefficiency at every level of the supply chain. US sanctions, particularly those imposed during the Trump administration and reinforced under his return, have cut Venezuela off from the global capital markets. And not just global capital market, its advanced drilling technology and critical refinery components. And this has severely restricted its ability to maintain and expand the production. And it kind of forcing the country to rely on allies like Iran for crude processing and fuel imports. So despite having vast reserves, Venezuela's ability to extract and refine its own oil, it remains severely compromised. Now that's about the refining. But the economic activity is again kind of an issue because hyperinflation and economic instability have further crippled the sector, making it difficult for PDVSA to pay workers and maintain essential operations. So what that going to be in the result? Once thriving oil industry now produces just a fraction of its former output with operational inefficiency, equipment failures, and then the logistical hurdles, it kind of creating additional bottlenecks. And now the Trump is imposing 25% tariff is yet another blow. This move is specifically designed to tighten the economic noose around Venezuela by targeting its biggest buyers. And you know what? Who is chief among them? China and India. China, which has a long used oil for loan agreements to secure Venezuelan crude at discounting rates, now faces higher costs, and that could make it reconsider its commitments. If Beijing decides that the tariff is too steep, you know what it will be going to happen? It might pivot toward Russian or Middle Eastern suppliers and significantly altering global crude flows. India is another major buyer of Venezuelan oil, is in similarly difficult position like China. So while it has historically taken advantage of discounted Venezuelan barrels, the added economic pressure may force Indian refiners to reevaluate their sourcing strategies. And you know what? Sourcing strategies are fairly important in the refining business. So if both China and India they kind of scale back their imports, Venezuela could be left scrambling for new buyers, possibly turning to smaller markets or kind of resorting to more covert shipping tactics such as, ship-to-ship transfers and then the blending techniques to keep their exports flowing. But ultimately what will going to happen? Ultimately Venezuela's struggles are a combination of internal decay and external pressures. So while its reserves they kind of remain vast, its stability to monetize them is increasingly constrained. So the coming months will be critical in determining whether Maduro's government can navigate these challenges or, whether Venezuela's oil sector will face an even steeper decline than the current levels. And here is one more point. We have talked about Maduro regime in our previous podcast, but it's essential to speak out here. If the Maduro regime collapses, global oil markets they would experience short-term volatility with the Brent and WTI prices they kind of are rising due to uncertainty, potential supply disruptions, and speculative trading. It erupts and temporarily reducing Venezuela's already low production, and the production levels are so low that they are below than 1 million barrels, which is around 1% of global oil supply. However, in the medium term, post-Maduro government might seek to normalize ties with the US, and you know what? It kind of a potentially leading to sanctions relief and a gradual return of Venezuelan crude to the global markets, which would be bearish for oil prices. So these shifts, it could increase competition for heavy crude buyers, impacting countries like China and India, so which currently benefit from the discounted Venezuelan oil, while US Gulf Coast refiners might regain access to much needed heavy crude. And you know what? It could reshaping the trade flows globally.
You're absolutely right, Sandesh. With Venezuela facing an already decaying issue, along with that, if there is a 25% tariff, that is definitely a blow to it. So let's simplify it for our audience and break it down. Trump's executive order imposes a 25% tariff on any nation purchasing Venezuelan oil, and it will be implemented from coming April 2025. And this move aims to cut off revenue for Maduro's government while pressuring major buyers like China. So, Sandesh, could you tell us what ripple effects can we expect globally?
Well, Trisha, ripple effects are significant, and the immediate market reactions was clear. You know what? US crude futures rose by 1.5% within hours after Trump's announcement, and it kind of a reflecting concern about the potential supply disruption. So this tariff they directly impact China's independent refiners, or we simply call them as a teapot refiners. And they solely rely on Venezuela's heavy crude because they were designed in such a way that they can process any heavy crude in the world. So Venezuela's heavy crude, we call it as a Mere 16 due to its discounted pricing. With this added cost, China may reduce its purchases, reroute supplies, or even engage in workaround strategies like STS transfers and blending operations. So you know what earlier what happening with the Venezuelan crude? Venezuelan crude came coming to Iran, it got blended with the Iranian light crude, and then the vessel goes to the Malaysia, it will do the STS operations, and then that smaller vessel will go to the Chinese ports. So it is a kind of a short operations, but they kind of a used to that, and they kind of achieve their exports and achieve their sales with the Shandong refineries specifically. Now India, it's another major buyer and now faces a kind of a difficult decisions because it continued to purchase Venezuelan crude at higher cost. You know what? To diversify energy imports. Indian refiners are likely already exploring alternative options such as increasing imports from the Middle East, Russia, or even the US itself. But meanwhile, Russia and Iran see an as an opportunity to expand their market share, potentially strengthening their energy ties with the China. Now, from the US perspective, refiners that process heavy crude could benefit. As Venezuelan crude oil becomes less competitive, we may see that refiners will kind of always get benefit because it has a higher margins. Now the Gulf Coast refiners in the US, which have historically depended on imports of heavy crude, they kind of gain better price leverage in the market. At the same time, what will happen? There are concerns that Venezuela may increase shipment through unofficial channels such as offshore transfer in the Southeast Asia, to bypass these tariffs. We are likely to see a rise in oil cargoes being relabeled and rerouted through intermediaries nations to mask their origin. And it is a key issue because for the global shipping industry, it is kind of an opportunity to tackle down these dark operations. Well, having said that, let me also tell you an interesting thing to look out for. The new 25% tariff on Venezuelan oil will likely benefit Canadian crude by making Venezuelan barrels less competitive in the US market, particularly for US Gulf Coast refiners that rely on heavy crude. With the Venezuelan oil become more expensive, demand for WCS, that is Western Canadian Select, it could rise, and it kind of a narrowing WCS WTI differential in the short term. So there is an advantage for Gulf Coast refiners because they have Trans Mountain pipeline which is already operational, and it allowing more Canadian crude to flow to Asian markets than competing for US refinery demand. Additionally, if China, it's one of the Venezuela's biggest buyers, it reduces its imports due to the tariff, it could turn to discount the factors like Alberta's production growth, then the price differential, and the global heavy crude supply that shifts majorly driven by geopolitical developments. However, the 25% tariff on Venezuelan oil could indirectly boost Aframax demand ex Vancouver, especially as more Canadian crude flows towards Asian market via TMS pipeline. So with the Venezuelan barrels becoming less competitive in the US market, Canadian producers may seek alternative buyers, particularly in China, India, and even the Asia Pacific market, or even in the countries like Southeast Asia. So the shift, it would increase demand for Aframax tankers, which are preferred vessel for the loading crude at Vancouver's West Reach marine terminal due to port constraints. However, the ultimate impact depends on WCS price differentials and Asian crude demand, which is kind of a stable and decline over the past few months. If Canadian crude remains cost competitive versus Middle Eastern and Russian barrels, we could see a steady rise in Aframax fixtures from Vancouver to Asia. So conversely, if Asian refiners, they kind of prioritize cheaper Russian or Iranian crude, the impact on Aframax demand may get muted. Additionally, US Gulf refiners, they kind of a response to Venezuelan tariff, and it will shape the trade flows. So if they replace Venezuelan barrels with the Canadian crude, more volumes may stay in the North America, and it kind of a limiting the boost to Aframax exports from the Vancouver. Now, when I'm saying the Aframax fixtures increasing, Aframax, demand supposed to rise, we may see there is around 5 to 7% increase in the Aframax tonnage demand from this particular area, and at the same time around 2 to 3% displacement in the ton mile balance. So having said that, Aframax market is looking good, and there is an opportunity, even if we may see that global heavy supply is getting declined in the coming months if this tariff is coming online.
You're absolutely right, Sandesh. But I think it's also important to know that it's not just about numbers and policies. It's also about the people. The Venezuelans, they have endured years of economic hardship with inflation skyrocketing and basic necessities becoming scarce. So, Sandesh, how do you see on that point that how do these sanctions affect the ordinary citizens?
Well, thanks for that question. I was kind of expecting that. So while the sanctions and the tariff, they kind of are designed to pressure Maduro's regime, they ultimately hit ordinary Venezuelans the hardest, and they kind of are deepening the hardships they already face. So basically you have to know that why sanctions is implemented. Sanctions are usually implemented. There are two entities here. One is the one who is sanctioning, and the other one is the country who is getting sanctioned. It's not always a country. Sometimes it's a group. It's a group of individual entities. Sometimes it's a group of countries. So sanction is placed because a country want to change opinion of another country, and that's why the sanction is in place. It is expected that eventually they will going to change their opinion. But like I have said already in many times, the sanctions never worked. They have never worked until now, and they will even, it's my personal opinion, they will not even work in the future. Having said that, these sanctions, we were talking about the sanctions and tariff, they are kind of designed to pressure Maduro's regime. So they ultimately hit ordinary Venezuelan the hardest and deepening the hardship they already face. So inflation, which kind of a slightly eased in recent years due to increased oil export, it could spiral once again. And if Venezuela struggled to sell its crude outside northern hemisphere, a shrinking economy means even fewer jobs, lower wages, and skyrocketing cost of everyday essentials. Now, having said that, there are a lot of issues are there and they are catastrophic. Even we have seen there is a uh, kind of a scarcity for food and fuels and all the basic necessity together, and it kind of a putting more people into hunger. The medical facilities are not there. We should be kind of having optimism towards the things that are currently going on with the Venezuela, and we hope that situation will bounce back in near future.
Thank you so much, Sandesh, for explaining that so well. But let's paint a picture for our listeners. It's a tale of two nations, I'd say. One is Venezuela and the other is China. On one hand, Venezuela is struggling with political turmoil but holds immense natural wealth. And on the other hand, China is a global powerhouse which is navigating sanctions and tariffs while maintaining close ties with the Venezuela.
Exactly. It's a fascinating contrast. The world's largest oil reserves locked beneath the political dysfunction versus China's relentless pursuit of energy security in a rapidly shifting market. China has long used oil for loan deals with the Venezuela to secure supplies, but it has also been growing wary of the risk. So one thing I want to mention here. So when any country they kind of faced sanctions, always kind of a look for loopholes or kind of a look for allies. Historically speaking, we have seen Iraq, which having a food for oil program, and something similar like oil for loan program Venezuela is currently dealing with the China. So it's a growing worry of the risk, and the new tariff by US, it kind of forces Beijing into strategic dilemma. So what is that strategic dilemma? So does it absorb the 25% levy and continue importing Venezuelan crude, or does it pivot towards alternative supply like Russia, Iran, and the Middle Eastern producers? So let's discuss this from the point of view of example. Let's say crude oil prices are around $70 for barrel for Venezuelan heavy crude. If they eventually given discount to China, that discount will range around 10 to 12%, not more than that. But if this particular tariff is implemented, the actual cost of crude oil will more than 13% or 12% than the actual price offered in the market. And 13% higher price means the actual margin levels will get declined, and which is not a good thing for any refinery, because refinery has to maintain margins all the time to run it profitable. Now, having said that, with the global oil markets, they already in flux due to US sanctions on Russian and Iranian barrels. China now has to China now has to reassess the cost benefit of maintaining its reliance on Venezuela. Now, for the Maduro's government, the stakes are even higher. Struggling under US pressure and economic mismanagement. So those points we have discussed earlier. So Venezuela needs every dollar it can generate from oil exports. So losing a key customer like China, or even just a significant reduction in volumes, it could force Caracas to deepen its financial entanglement with the Moscow and Tehran. We are already seeing signals that Venezuela may increase its barter arrangement with Iran, for trading crude and refined fuel, for trading crude for refined fuel and industrial support, while Russia could step in as an intermediary to facilitate disguised shipments. So this geopolitical balancing act is intensifying. If China chooses to maintain its Venezuelan imports despite the tariffs, we might see more indirect transaction, and the third party shipping routes like bending strategies or even re-exports from Asian trading hubs to obscure the crude origin. However, if Beijing decides the tariff is too costly, we could see the redirection of Venezuelan crude flows to the even riskier buyers, and even in the non-aligned nations, and potentially at even steeper discounts. So the coming months will be a crucial in determining how this relationship evolve. Will China stand by its long-term energy partner, or will it prioritize economic pragmatism over diplomatic ties? How will Venezuela adapt if its primary oil buyer pulls back? And what role will Iran and Russia play in propping up Maduro's regime amid shifting global trade patterns? So these questions that I've just said, it kind of shape not only the future of Venezuelan oil, and not just oil but even economy also. But these particular questions, they also broader geopolitical alliances in the energy sector.
You are absolutely right, Sandesh. I guess we'll have to wait and see how this plays out for both of these countries, especially Venezuela. And with that, I guess I'd have to say it was a really insightful discussion having you in our podcast. And thank you so much for sharing all your analysis and views in this topic.
And thank you, Trisha, for inviting me once again. And it's my pleasure to be with you, discuss with you, and to share my knowledge and views with our audiences. Thank you for inviting me once again.
And with that, I guess that's a wrap for today's episode. And to all our listeners, thank you so much for tuning in. Do not forget to share and subscribe. Until next time, navigate safely and stay informed.